Recently, there was a broker's circular which achieved a lot of publicity in the global media. Not surprising, really, because the title of it was, "What if the last smoker quits in 2040?" In fact, the purpose of that circular was to downgrade two of the largest tobacco companies in the world from a buy to a hold status. Why was that? Well, there were sentences in that circular which said smoking could virtually disappear in some markets in 30 to 50 years. Now, how did they calculate that? What they did was make some projections of the fall in smoking prevalence in a number of markets. Now, smoking prevalence is the proportion of the adult population who smoke. Now, we tried to mirror what they'd done with our own figures at Euromonitor. What we found was that the last smoker will light up in the USA in the year 2063. The last smoker in Japan would light up in 2072, 9 years later. Will it happen? Our view is that you can't really do straight line calculations based on prevalence. Why can't you? Well, consumers are trickier than that. They tend to get resistant when they have problems imposed on them, like higher prices, or in the case of smokers, like smoking bans. And when they become resistant, then prevalence tends to fall slower. So, looking to the future again, we'll dismiss prevalence calculations and we'll do some of our own calculations based on volume trends, which is probably a fairer way of looking at the whole issue. What we did was establish some compound annual growth rates for the tobacco market from the year 2009 to the year 2040, based on historical trends. What we found, in fact, was that, taking Japan, for example, the market would be 80% smaller in 2040. The US, Brazil, the UK, 30% smaller. The significant thing is, volume falls affect profits. Now, I'm looking to the future here. I'm not saying that so far volume falls have affected profits, because in fact all the tobacco companies have been recording far higher profits, even when they've been recording lower sales, lower shipments. Meanwhile, only 8 of the top 25 tobacco markets, this is in 2009, actually rose. The rest all fell. 2010 looks like an even worse ratio, worse for the industry, that is. So we had big markets: Japan, US, Spain, Brazil, UK, Mexico, Poland, Malaysia, Russia, India, big markets falling in volume. China carried on rising, so world sales didn't change much. But most of the big companies, all the big companies, don't sell many cigarettes in China. So that doesn't help them very much. Because price is the linchpin of tobacco industry profitability. We've had a situation where the companies have even been quoting what they've made in terms of pricing gains in their annual report, almost as if it was another product category. Now, it may be, and some people have said, that these pricing gains were actually slightly lower in 2010 than in 2009, though it's hard to calculate. The point is, much depends on pricing strength for the companies. Now, if they can hold their price rises, then they carry on making profits. But can they? Well, one thing that stops them in their tracks is when you get a big tax hike at the same time as a manufacturer price rise. Now, in some cases, consumers say, whoa, wait a minute, this is just too much. So what do? They downtrade to a lower price brand, or worse, for the industry that is, they stop. Now, we've already had examples when the double whammy of manufacturer price rises and tax-driven price rises have, let's say, pushed the pricing elasticity of demand too far. And that is when alarm bells ring for the companies. We've had examples in Russia, we've had examples in Mexico, and we've had examples in Spain. The point here is, and this is the reason why the companies were downgraded in the broker circular, it was the perception that pricing strength in companies cannot survive volume fall indefinitely. It can survive it in the short term, and it is doing, and it can maybe survive it in the medium term. But ultimately, if volumes keep falling in the markets where the primary profits and sales are made by the companies, then inevitably profits will not be as strong as they have been. This perception creates the nightmare where tobacco company shares are downgraded, where the price to earnings ratio is reduced because the future is not perceived as profitable. So this makes the paper, the shares of the companies less valuable. The thing is, we've been here before in a sense. Back in the 70s, there were a lot of fears about the future of the tobacco industry, and the strategy that the companies adopted was to look at their own price to earnings ratio, compare those to food companies and financial service companies and other consumer markets, and say, although we make better profits than them, their PE ratios are higher than ours because their future is better perceived. Therefore, why don't we buy those companies, use the cash flow of tobacco, which is unmatched, to propagate food companies, financial service companies, etc. Create conglomerates with higher PE ratios than tobacco companies. So that's what they did. So we had Philip Morris was actually, in the 70s, the biggest food company in the world. It was bigger than Nestle. And not far off that, we had R.J. Reynolds Nabisco, which was also a massive food company. We had British American Tobacco owning Marshall Ward, the retailer, and other retailers like Argus, and it owned Eagle Star Insurance, Allied Dunbar. It was a massive financial services company. Imperial owned breweries, a number of breweries, food companies, even owned the iconic Howard Johnson restaurant chain in the US. Soon after, in sort of historical terms, thinking changed. All the non-core businesses of the tobacco companies were sold off. The conglomerates were broken up. All of them went back to core values. It was a change of fashion in financial thinking in the city. It also made a lot of money for the people who were arranging it. But the question now is, has the wheel come full circle? All the arguments that were used in the 70s concerning upping the value of tobacco by tying it to companies with a better future still hold, particularly in the current climate. So, are we going to see tobacco companies buying into other consumer goods companies again, investing in tomorrow, trying to get a better cash flow that way?